The stock market's volatility is about to go absolutely insane, something that hasn't occurred since 2020 and before that, the 2008 financial crisis. In the past, spikes in volatility have often coincided with large drawdowns on the S&P 500. Today, however, the stock market's volatility has reached the lowest level in over 4 years, as the S&P 500 index has reached record highs. This low level of stock market volatility is comparable to some of the most stable periods for stocks of the last 3 decades, like the early 1990s, the early 2000s, and between 2013 and 2019. This is despite clear evidence that the U.S. economy is beginning to show cracks. Consumer delinquencies in the U.S. have moved significantly higher over the last year, recently reaching the highest level since the financial crisis. Variations in consumer delinquencies throughout the last 30 years have been very much correlated to stock market volatility. Typically, rising delinquencies is associated with periods of rising stock market volatility, which is normal because rising delinquencies show the economy is weakening, and so that creates uncertainty among investors. And of course, the opposite is true when delinquencies are coming down. That's very much associated with lower levels of stock market volatility. Today, however, this relationship has completely broken down, with delinquencies rising significantly over the last couple of years, while market volatility since 2022 has clearly been on a decline. I'm going to show you why this likely won't last long, the exact timeline for when we should expect this type of spike in volatility to occur, and exactly what that means for the stock market. And it all begins, of course, with the United States Federal Reserve. They control what's called the price of money by modifying the federal funds rate, which is the interest rate at which they lend to other banks. They increase their interest rate when they want to limit borrowing and slow the economy down, which often creates recessions, and they reduce the interest rate when they want to encourage borrowing and stimulate the economy. Now, if we add the volatility index of the S&P 500 on top of the federal funds rate, we can't immediately see any direct impact of the interest rate on market volatility. But if we shift this interest rate forward by a little bit, we can see that there's a very strong correlation between the two, but just that there is a lag time between what the Federal Reserve does with its interest rate and when that is actually felt by the economy and financial markets. And this is something that academic economic research actually supports. This paper from the Bank of International Settlements has this chart in it that shows the impact of monetary policy on economic growth. It gives us what GDP looks like in the 12 quarters following interest rate hikes. So this is a 3-year time span, and we can see the real negative impact of monetary policy on growth is felt between around the 6th and 9 quarters following interest rate hikes. So that is about an 18-month lag time, which happens to be exactly the amount of time by which we shifted forward the Federal Reserve interest rate on this chart. Today, this chart is suggesting that market volatility is going to bottom between today and October of 2024, and then spike possibly to quite elevated levels. Now, the question is it going to be closer to today, or is it going to be closer to October? Unfortunately, we don't have a crystal ball, but the price action that we're seeing on the S&P 500 remains without a doubt bullish. The S&P 500 is trading at all-time highs within a clear uptrend, with all of its key moving averages pointing upwards. For now, this does not look like a market that's ready for a massive spike in volatility. The S&P 500 has managed to break above this key line of resistance that we've been watching with our members. For now, this is objectively a sign that market volatility could continue to decline, with the market rising over the next few months. If we see this turn into a false breakout, that starts to have a bad technical look and opens the door up for more downside on the S&P 500. So we're watching this very closely for all of our ongoing trades on the website. One thing that many people have been concerned about today is the very small number of stocks that's actually pushing the S&P 500 higher. Indeed, when we look at the number of stocks that are participating in this rally, we've seen it on a steady decline since January of 2024. Less than 50% of stocks today are trending up, despite the fact that the stock market has clearly been trending higher. Now, to be fair, this is also something that we saw in 2023, where market breadth declined between January and May of 2023, with less than 50% of stocks trending higher in May, despite the fact that the S&P 500 was moving higher. Eventually, that actually led to a significant breakout, with a much larger number of stocks participating in the rally and the S&P 500 going on a melt-up. So although the low number of stocks participating in this rally is concerning and does make the S&P 500 look less healthy and more vulnerable, it's also possible that market breadth can recover here and lead the S&P 500 for another leg up. Since the end of April, we've been long on tech that have been outperforming the S&P 500 quite nicely just over the last couple of weeks. You can check out the closed trades that we've had in 2024 on our landing page. We've had so far, it's been a great year at Game of Trades. While we cannot make any guarantees, we're going to do everything we can to keep this going, keeping anybody that's following us on the right side of the market.